Hi, everyone. Thanks for investing the time to meet with us today to talk about stimulus fraud. My name is Simon Moss. I'm CEO of Ayasdi. I'm joined by Richard Stokes, our Financial Services Chief Product Officer. We're looking forward to talking to you for the next 30 minutes, really around what is this stimulus fraud thing that everybody's going on about? Do we really have an exposure between $3 and $6 trillion that's being injected into the US economy over the next few months? What are the attacks that we are expecting? What are the malignancies? What are the frauds that we should be expecting? And what should we be looking for to discover those frauds? There's obviously a ton of other impact that's going to have. How is AML going to change? Are we going to see a securitization of this new asset class called stimulus loans? What is going to happen to small and medium business banks from a liquidity perspective? So there's a lot of stuff that we're going to talk about, and we're really going to cover it in two time periods. One, the short term around stimulus between 18 months and 2 years, and then a much, much longer time horizon in the whole way that anti-money laundering is going to change because of the activities that we're seeing at the moment over the next decade or so. It's a bit gloomy, to be perfectly honest. It is going to be a golden age of financial crime. We are going to be inundated by fraud. But at the same time, there is actually some good news. And so we're going to finish with some areas that we're really making some great progress with. So with that in mind, thanks for joining us. Hope you enjoy the next 30 minutes or so. And so I'll hand it over to Richard to carry on.
Hi, thanks for joining us. I'm Richard Stokes. I'm the Chief Product Officer of Financial Services at Ayasdi. And I'm going to run through what the industry is telling me was thought or planned for the stimulus packages that are being released. The financial institutions, as we know, are being used as a vehicle for distributing those government funds, those massive amounts of money to those in need. They themselves have been deputized as loan approvers by the SBA, who are now approving loans at a massive rate unseen before. And these financial institutions think the government is liable for the funds, and why wouldn't they? The US government themselves issued these funds very rapidly. And to support the banks who are undertaking a massive risk, they have relaxed a number of banking regulations. Or as I question, have they? An inspector general has been appointed who is playing the role of the investigator, handing bad findings off to law enforcement and the DOJ, who are catching the criminal activities that are being perpetrated by the bad actors. It's a nice and smooth system, right? The reality is the challenge we're going to see is not going to be now. This is not a KYC issue, despite many thinking it is. What will happen is at the time of forgiveness, the financial institutions will come under greater scrutiny. They're going to have to perform retroactive due diligence on these loans and the businesses that have asked for them. Their loan collections are going to go down as forgivenesses increase and as defaults increase. This increases their overall risk and their fraud loss. And they believe the SBA is liable because the SBA told them so. And the reality is that the government, the SBA, is going to say that the FI, the bank themselves, is liable for fraud because of poor custodianship and collection of that debt, the due diligence. This is going to end up in decades-long lawsuits through the courts, through the judicial system. We're going to see what we saw in 2008 and beyond. Now, 3 key points to remember on this page are that despite the relaxed KYC regulations, the BSA adherence is absolutely called out, and it is likely to be doubly enforced in the future. Lenders faced massive fines in 2008, and they run the same risk of these fines in 2020, 21, and beyond. And to be honest, your liability as a financial institution in the future depends on the actions you take today.
So some big challenges. We're making significant decisions around massive loan portfolios, huge amounts of customer relationships in lightning speed, which will have an impact on the efficacy of the financial institution over the next decade or so. Why is this so challenging? Well, if you look at a regular business, whether it's a loan business, whether it's a store, whether it's any business, you really have 3 principal components to how you run it. One is time. How long does it take you to do something? 2 is cost. how much does it cost you to execute that something over time? And third is risk. How risky is it that you're doing? Within the loan portfolios that we're seeing, and with it for loan officers, we're seeing up to a 15,000% increase in the number of loan applications per day at most firms. At the same time, regulations are being dropped. And so what we're doing is we're trying to expedite loans to large amounts of businesses, large amounts of individuals who have an absolutely existential requirement for this money, and they absolutely should be serviced. But the pressure to make those decisions quickly is really squeezing this triangle to be able to look in a completely different way. Now remember, time, risk, and cost is a partial derivative of the other two. So you can reduce your risk by increasing your cost and taking longer to make decisions. But we've got a complete opposite. What is happening is that loan officers have to make decisions at incredibly fast speed at this point, because we're dealing with firms going into bankruptcy. We're dealing with mass unemployment issues. And so costs are actually increasing, number of loan officers, number of individuals being hired into banks to try and deal with the volume. But ultimately, the time is being compressed so much that the only approach to actually solve this loan application crisis is to drive risk into the system. Now, what that means is 4 fundamental problems. Because the regulations are dropped, because we're making decisions so quickly, there is a very, very high probability that large amounts of money is being stolen. If we look at a well-orchestrated, well-run stimulus plan, TARP, 2008, 2009, they factored in about 10% that was considered in fraud. And that was a well-orchestrated, well-managed stimulus focused at a finite or small number of entities, the banks. We're dealing with a mass number of applications, a large number of institutions, and therefore the probability of fraud is way beyond 10%. So there is a fair argument in saying, given that KYC regulations have been largely dropped, particularly for existing customers, that most of the money has already been stolen or has a high probability of being successfully stolen over the next few weeks. And when we say few weeks, we're talking about hundreds of billions of dollars of theft. We are talking about the largest theft in the history of the world. And financial crime is already the most successful business on the planet. And so it is literally a golden age for financial crime. The vast majority is actually being stolen by customers that are already past the KYC structure. And it is awful to actually consider that there are many honest, hardworking, diligent businesses out there that are being pulled into a lot of the challenges that we're talking about here. But we have opened the financial system up to significant malfeasance, significant attacks. And overemphasizing KYC, given what regulators have applied to the KYC requirements, particularly FinCEN, frankly, is pointless at this point. So with little due diligence in loan issuance, the due diligence is going to move from the execution of the loan to the forgiveness of the loan. In other words, we need to understand whether the entity that is receiving the loan is going to be able to stay viable, or the loan will need to be forgiven. So the question at that point is, well, if it's being forgiven, who's liable for the forgiveness? Who's liable for the money that is being forgiven? Well, if it's a fraud, the answer to that is extremely nebulous. And so what we need to do as an industry is begin to change the way we look at loans, from switching from pre-loan pricing and servicing to post-loan behavioral validation, and then rapid investigation to understand and apply a metric on whether a loan will be forgiven or not, or whether a loan will be requested for forgiveness or not. It's a completely different asset class, a completely different analytical challenge and workflow and change management challenge that the banks are facing. The participants are varied. Obviously, the criminal elements are very well known. We're dealing with organized crime. We're dealing with rogue states. We are aware of stimulus checks being paid abroad now, simply because they have an address in the US, even though they're residents of Middle Eastern countries. We're aware of individual opportunists. There have been a couple of things in the press. I believe DOJ published something around Massachusetts recently. But the actual identification of these frauds are still few and far between, primarily because we are sucked in to try and get in as much money into the hands of appropriate people as possible. So stimulus fraud, therefore, is not just the criminal elements, but there's a large degree of collusion as well. So when we're looking, we tend to look at management, we tend to look at the customer, and the other area is supplier, which is an area that we're very interested in, particularly around the involvement of changes within the accountancy and the lawyer support of a particular business. So looking for stimulus fraud is not a simple change of behavior requirement. It is rather a highly complex, multivariate challenge with multiple elements of collusion within different departments and different units within the firm. A couple of examples that we've been really interested in. The distressed business takeover, shuck and clean, as we're calling it. The distressed business takeover is a fundamental Trojan horse for money laundering and terrorist financing in the future. I own a restaurant, or I own, a small store. My life saving is in it. My kids' education is in it. It has been closed for 6 weeks now. I have no receivables. I have fundamental problems in being able to pay employees. I've released employees. I've furloughed employees. But at this point, the very viability of my business and my livelihood is in question. People turn up. They offer cash to buy my business. I have to say, everybody, I would be tempted to protect my family's livelihood, to sell my business for cash. I would potentially, and I would definitely look at it. And many people are facing that significant challenge. We saw a lot of events of the involvement of the mafia in Italy. We're seeing the same thing in New York. And so flourishing businesses can be overtaken, can be taken over, forgive me, by organized crime simply because of desperation of the owners. And what that means is we are creating a whole new category of shell companies that can access seamlessly the financial system. So how do we find some of this? Well, we're looking at some red flags. The bold ones are areas that we're most interested in. But generally, a business that is flourishing and surviving in this environment compared to other businesses of a similar industry or a similar segment, they haven't actually applied for a stimulus loan. So there is a significant delta between other firms in a similar industry applying for loans and this firm not. There is a change, and this is where we were talking earlier, a change in the legal or accounting representation and or documentation. That is a big red flag. Most organized crime will seek to use their own legal and accounting teams because most legal and accounting teams are, frankly, extremely ethical and extremely loyal to the law. So obviously, changes in the receipts, changes in the receivables are always going to indicate a red flag. A significant acceleration in the business model as well is another big red flag. They're doing a lot better than they should be. They become an outlier. And obviously, new cash injection. But the other one that we're very interested in as well is changing signatories. Somebody new can actually now sign for activities and for receivables and payables within that institution, within that firm. So what has happened is the ownership has not changed, but the control has, and that's the red flag that we look for.
And Simon, one of the things there on the SBA 7A loan program, since the beginning of this year, the 7A loan program has seen a 13% change of ownership within it, driving the request for these loans. I'm suggesting that beyond just the the PPP and the EIDL that are part of the stimulus program, among others, that we have a responsibility to look at associated products and services available as well, because I think there are large indicators in there, particularly when we talk a change of ownership. You just mentioned change of control. I think that might be the attempt at a more legal approach to bring bad actors into the institution.
That's an excellent point. This last point should be bold. Whistleblower and anonymous tips. Many employees, we will need to rely on a lot of good people making phone calls, expressing concerns, highlighting problems within many of these firms as organized crime begins to penetrate. But I think we have to accept that we are going to have multiple new shell companies attacking the system over the next decade or so, primarily because of the stimulus fraud issues that we're facing. So this is a takeover of a whole company. Within the company itself, we are seeing some really interesting activities around the employee, and the employee is really being treated as a fungible unit, an interchangeable financial component of a fraud. A key denominator of a stimulus loan is the employee. I have a number of employees, these are my salaries. I'm not going to release any of them as long as I receive a loan from the government through a bank. So understanding the characteristics of the organization, understanding the characteristics of the individual employee is extremely important to be able to prevent employee stuffing. In other words, loan applications that has more employees than are actually real. Employee shedding. I have all these employees that I've made a loan application for. The loan has been received. Okay, I start letting them go, or I turn them into consultants, and therefore I save from a healthcare perspective. And that's a 20 to 25% delta. Or payroll kiting, which is I've actually just inflated the salary of the individuals. So payroll information is going to be an extremely important input into being able to discover these behaviors. But some of the red flags that we're working on with our clients, out of sync employee numbers versus industry norms. I own a restaurant, I have 350 people. It's a ridiculous comparison, but there are some interesting areas to be able to say, well, how many people on average work at a restaurant in Philadelphia? In average, work in a restaurant in Akron, Ohio. So really looking at demographics, looking at norms, looking at neighbors, looking at direct comparisons, you can begin to understand some areas. At the same time, out of sync employees relative to seasonal or historical norms. And then total salary versus salary count. I've got 10 people, but my salaries are, $5 or $6 million. There we can see an interesting money laundering issue as well, because inflated salaries in employees is often a very interesting way of moving money through a shell firm in a money laundering scheme. Shedding. Now, all of these activities, all of these red flags are relevant for all of these three behaviors, but there are some specifics. Red flags on employee shedding is frankly an easy one, a rapid reduction in payroll. But at the same time, an increase in potential HR suits. Here, the whistleblower and anonymous hotline becomes extremely important, as does the change in attorney and accounting firm to actually cover these elements. And those two, accounting firm and whistleblower, are relevant for all three. And finally, payroll kiting, essentially a way to inflate salary for direct loan purposes and moving FTEs to 1099. In other words, saving the money for healthcare, saving the fully loaded costs, but still applying for the loan. And so here, a meaningful reduction in health, 401k, and benefits deductibles in pay slips is an area to focus on. Now, we do have some challenges here in GDPR and CCPA from a data security perspective, but it is imperative that to be able to identify these behaviors, we are going to have to get a more intimate more complete understanding of the characteristics of the organization and the employee.
So other things to consider beyond just the immediacy of the fraud are how fraud affects liquidity, what we're calling the bank liquidity contagion. So client liquidity and credit risk liquidity, particularly in the mid-market banks. And if you look at who's been giving out these loans and getting it to their people in their communities so quickly, it's a lot of the mid-market. We've seen, just on a digression, we've seen lawsuits filed on day one of the stimulus release for the larger banks who said that they weren't paying out these loans, or that the loans they were paying out were being used against people's overdraft, things that were turned around. But what ended up happening was that mid-market banks picked up the brunt of this. In some cases, it was really good for business, profitable. In some cases, it was really good for the community, good for the reputation. Liquidity impact on direct fraud losses. I look at fraud and I say that I'm likely to be, I don't know what the future holds, but I'm likely to have to hold more money back in reserve for that. That's going to have an impact on my liquidity. And remember that we're expecting over $500 billion in fraud across the system. And that's just in the United States alone. Other countries have other stimulus packages and they have their money. We're talking about nearly $7 billion globally. AML fines.
Trillion.
Sorry, trillion. I'm sorry, trillion.
Crazy number.
$6 to $7 trillion globally. AML fines will increase. Fraud begets money laundering. If your programs and processes weren't in place, you're going to have to hold more money back for what is likely to be an increase in regulatory scrutiny and AML fines. Those reserves affect your liquidity. And forensic and legal counsel that is going to be needed to fight these lawsuits, to defend against the litigation, will need to be held back. All of that affects bank liquidity.
So securitization is the other area that, you know, we're going to cover at a later date. We are dealing with a whole new asset class. Stimulus loans is a new asset class. It has different risk parameters. It has different longevity. It has different pricing model, whatever that pricing model is at the moment. But we're really looking at $3 trillion of additional asset class being fed into the system. That's going to require a secondary market. That's going to require a utility. So what is important is to have a risk model that understands forgiveness risk, that understands, will an entity ask for forgiveness of the loan? Will the entity do a runner on us? In other words, it is a fraud. And so that we can actually begin to apply a clear understanding of what the asset is to accommodate a utility, to accommodate a securitization model, to accommodate a secondary market. I think that we are at the very embryonic stage of exploring this. I also believe that in 2008, the lessons of 2008, 2009 will be learned, that we will be able to avoid the creation of toxic portfolios of non-performing assets. But the key will be to create an understanding of forgiveness risk, a new model that will underpin the securitization of these assets. It's a really, really interesting opportunity for an enormous amount of innovation in this space. And I think can form a very powerful foundation in how the financial system works together as a central utility to both manage risk and also to manage financial crime. So what's important? What's important over the next 18 months to 2 years? What's important in stimulus at the moment is that we got to get money into the right hands of people. All our economies are hurting. All of our businesses are hurting. The very DNA of our economies are being challenged. So we've got to accept that the horse has bolted, that the money is being stolen or has been stolen, and we are not prepared to stop it at this point. it is going to be a forensic investigation moving forward. We are going to have to investigate and discover because we are not able to interdict at the moment. So there is going to be a lot of research, a lot of recovery, and unfortunately, it will probably end up with a considerable amount of litigation between the banks and the SBA on who is essentially liable for these activities and these frauds. What that means is, given the lack of due diligence, a deeper and more granular understanding of the client is going to be needed so that we can understand the characteristics of forgiveness. And so, interestingly enough, KYC is really important. But the hyperbole of KYC now is not. KYC and the requirements of KYC and stimulus fraud in the stimulus loan has moved from the provision of the loan, because FinCEN is now saying, no, we're actually not that bothered about it, particularly if it's an existing client, to actually the forgiveness of the loan. And so an additional amount of data is going to be needed, structured and unstructured, internal, external, beneficial ownership data, considerable amount of more complex analytical approaches to understand the customer will be required in the future as we begin to say, okay, what is the probability of forgiveness? What is the liability of that forgiveness? It's going to change process. It's going to change workflow. It is a new asset class. And we're going to need to accommodate this new loan structure with all the new risk constructs that it has. And the key here is the burden of proof challenge, because the burden of proof will be on the banks. And I think the SBA and the US government and the governments around the world will not simply accept a blank check. And I believe that we have some significant precedent to be able to set that from 2008, 2009. The anonymous tip line, and we put this in big and bold, and we're going to connect you to the anonymous tip line in the US at the end of this presentation, will be one of the chief weapons for regular people, employees, concerned individuals within firms to be able to reach out. There is also hotlines and whistleblower lines directly into the banks. But we're going to provide you with the connection to at the SBA hotline that I think is going to be extremely important moving forward.
So what's important moving forward? We've gotten through the fraud. The money has been spent. The money is in the wrong hands. So now we have an increase. Remember, $7 trillion globally, nearly. Now this money needs to be laundered, needs to be used through the very institutions that facilitated it in the first place. So the AML teams, the technology that is used, will be stretched more than ever, in many cases to the point of failure. We're experiencing 95 to 98% waste in what we do today. We're not catching the bad actors as it currently is. What chance do we have to catch them in the future? An increased amount of fraud today, it equates to an increased money laundering tomorrow. We know that. But we're also facing a whole new wave of shell companies, of complex UBO structures with different money movement patterns, new behaviors, all of which will be used for nefarious activities. One of the benefits of this kind of time when we've all had to stay at home is that perhaps the human trafficking, the sex trafficking has declined, but what it has done is it's forced them into other money-making behaviors. We're going to see a lot more of all kinds of financial crime moving forward. The Bank Secrecy Act will continue to be more fully and more aggressively enforced. Remember that even though FinCEN said they were going to relax the rules around KYC, relax the regulations around the amount of data that needed to be collected in KYC for existing customers, and in some cases, the overburdened workforce of banks has kind of relaxed some of that for new customers as well. FATF, FinCEN, everybody who is out there in the regulatory community is calling for greater adherence to the BSA. And I've put OFAC and FATF in here because while we've got our OFAC really governs sanctions and is not related to this area, them and FATF have been calling for a risk-based approach. And I know that as institutions, you are attempting through digital transformation exercises, through people exercises, process and technology implementations, trying to get there, but you are not there, and you need to be there. And my final point on this page is that unprecedented is a word that has been used an unprecedented amount of times since probably the beginning of March. Unprecedented means that something has been previously unseen or unknown. We're going to see this with regards to unseen or unknown attacks. We don't know what frauds are going to look like in the future. We've got some indications. We've given you some of them today. We don't know what money laundering typologies and shapes and behaviors and patterns are going to look like. So we need to take advantage of approaches that give us early warning of emerging risks. That's going to be essential to the smooth operations of our institutions and the adherence to the guidelines that we're trying to work with. It's going to be essential for survival moving forward.
Oh, it's all pretty gloomy. Oh, sorry.
It is.
Yeah, it is all pretty gloomy, but there is some good news.
It's all terrible, but there's some good news.
Well, it's not terrible.
It's truly terrible.
Yeah, go on.
The well-established criminal behaviors, when effectively hidden, could well be tempted to pursue these stimulus fronts. What we're seeing is the amount of money that is available is going to generate greed, and that greed is going to expose weak signals. They're going to show up. These signals, however weak within our data, these behaviors, however weak within our data, how barely perceptible, will be discoverable. One of my favorites with this period of time, with the 2008 period of time, with other stimulus programs, perhaps related to Hurricane Katrina and Sandy and the TARP program, it is this large cash tide recedes. Existing crimes that are in your institutions that are happening across the world is going to be exposed. Now is the time to uncover Ponzi schemes and look for indicators for massive amounts of cash sitting idle, unable to be laundered by the bad guys. You've got an opportunity now to start looking for new bad actors and new typologies. It's there in your data today.
Yeah, there's no doubt about that. You know, we are going to face new attacks. We are going to face new, highly creative ways of fraud. But at the same time, Richard is right. The tide is receding. Cash is completely flush in the market. There's enormous amounts of traditional money laundering firms and businesses are not able to launder money at the moment. And therefore, there are a lot of signals out there that can be detected, that can be discovered, not by systems that were built 20 years ago to deal with the US Patriot Act, but by new AI engines, but by new intelligent, supervised and unsupervised learning approaches, by new and highly creative subject matter experts that want to execute on the mission, that understand that this is not just a regulatory challenge, but this is a fundamental fight against individuals that seek to do harm to our system, to our society, to our way of life. So investing in the right tools, the right techniques, the right technology, and stimulus, believe it or not, could become a renaissance for identifying new financial crime, be able to interdict on financial crime. And obviously, you know, it wouldn't be an ASDI show if you didn't know who we were going to recommend to do this. We're dealing with multiple issues at the moment, dealing with multiple clients, finding some amazing behaviors, amazing new rules that we're seeking to work with the examiners on, whether that's in tax evasion, whether it's in stimulus fraud, whether it's in money laundering, whether it's in conduct risk, and whether it's in the causal relationship between all of those crimes, all of those systemic challenges. that many of the banks face. So if you want to know more about what we're doing, how we're doing it, and how we can help you deal with some of these really significant challenges that we're going to face both in the short term and in the re-engineering of our financial crimes business and the attacks that are coming across and are hitting us over the next decade, drop us a line and we'll give you a quick 30-minute demo and you can see how brilliant we are. So with that in mind, here's the hotline, general fraud hotline at the SBA. If you know of anything, please give them a call. Please distribute this. And please make sure that if there's anybody who wants to go, this is completely anonymous. And we believe that this is a very, very powerful asset to help us on what is going to be an enormous threat to the financial system that will transform the very DNA of our economy over the next decade or so. So thanks very much. Quick 30 minutes just to give you some background. We hope you enjoyed it. We hope you thought this was useful. We look forward to seeing you using some of the examples. We look forward to hearing from you guys to get a demo. And with that, Richard and I would invite you to give us any questions that you have.
Yep, looking forward to the questions.